Hi, my name is Deborah DeRoy and we're here today at Columbia Threadneedle Investments. We're on the investment floor where all the action happens, and we're here today to talk to Mark Burgess, Chief Investment Officer. Mark, financial markets have been very busy in the last month. Columbia Threadneedle Investments are invested in all asset classes across the globe. You're a global investor, but what makes you different?
I think the thing that makes us different is the way we think about markets and the way we think about the interaction with markets. We're invested in all things everywhere, as you say, and we're constantly trying to interrogate and understand the interaction between economies and markets, macroeconomic events, geopolitics, and what that means for underlying securities.
Greece is dominating the headlines currently. Does this affect your view of European equities?
I think the issue with Greece is very different to the one it was 3 years ago. At that time, most of the debt was in private hands, and certainly the French and the German banking systems would have been very severely threatened. Today, most of the debt's owned by either the IMF or the ECB, and so Greece leaving the euro is not the big deal that it would have been.
So, moving back to the UK, has your view of UK equities changed following the surprise election result?
We got a surprise Tory majority, and that has certainly removed a lot of uncertainty, with the caveat that clearly one of the Tory party's policies is to have a referendum on Britain remaining in the EU, and that will unsettle investors and international companies until that issue is resolved. So it hasn't made us more favourably disposed towards UK equities, but it has certainly taken away some of the uncertainty.
Yeah. Now, moving to Asia, you have been overweight Japanese equities for some time, and performance this year has been very strong. Is it still right to stay overweight there?
The moves by the Japanese central bank in terms of stimulating the economy through Abenomics has been very, very significant. Just to put it into context, the US did 7% of GDP with its QE program, and Japan's doing 14%. That in itself has undermined the yen, which has made Japanese companies more competitive, and we've seen a very strong rise in the Japanese stock market as a result of that. But in addition to that, we're starting to see some very unusual investor-friendly behaviour by Japanese companies through Abenomics and through government encouragement. They are beginning to focus on what shareholders might want, and this comes on the back of a more competitive yen, which is boosting their profits.
Yeah.
So if they're doing other things to boost their profits, the already attractive valuation looks very favourable as far as we can see. So although we have seen a strong run in the Japanese equity market, we think it's still right to be overweight there.
Now, what is your view on oil prices, given that there seems to be an increased supply from Iran?
The oil price, as we all are aware, has fallen despite the geopolitics that we're seeing in the Middle East, and despite increasing consumption from the developing world. One of the reasons it's falling is because of the big supply boost we've had from shale oil in North America. North America in aggregate is now self-sufficient in oil, which is a very big change from what we had only 4 or 5 years ago. And we don't expect the oil price to rise sharply from here anytime soon.
How will China's slowdown affect global growth?
China is doing everything it can to stimulate its economy, and we have seen growth slow from the sort of 10-12% to the published figures of sort of 7% for this year. Nobody really believes those numbers. We all think that the real growth is much lower than that, but as a result of that, we've seen a very big run in the Chinese stock market. Now, how this kind of pans out is difficult to predict, but the expansion we've seen in credit formation in China, in other places, in other times in history, has not ended well. So we have to watch this very closely, because there's lots of bubbles forming that potentially be quite damaging to the economy.
Do you think that US interest rates rising will greatly affect emerging markets?
Historically, US interest rates rising, and more importantly a stronger dollar, has been very bad news for the emerging markets, and I don't see this as being any different. We would think that many of the emerging markets will be quite challenged by a stronger dollar environment, and that's one we certainly predict.
So in summary, what does it all mean, and can we implement this knowledge to our benefit?
I think we're living through very interesting times right at this moment. The US has signalled very much that it wants to start raising interest rates. It stopped its quantitative easing program, and the market expects US interest rates to start to rise towards the back end of this year and then through next year and the year after. So we think that equity markets will give us lower returns. We still think they'll be positive, but they'll be lower. And that easy beta that investors have enjoyed will have to now focus on alpha generation, and I think that really plays the strengths of an active manager that can pick stocks like Columbia Threadneedle Investments.
Well, thank you very much, Mark, for your valuable insights, and
Thank you.
we very much look forward to seeing you again next month. Thank you.